Thank you, Paige, and hello, everyone. This is Jim, and I'll be presenting our material today in Robert's absence. So welcome to today's webinar, Reserve Studies 103, the Funding Plan. Here at Association Reserves, our job is to help you plan for the inevitable major expenses facing your association. You need properly sized reserve contributions to perform your projects on time, minimizing the expenses that come with deferred maintenance, maximizing pride of ownership, and property values. So this webinar is designed to help you get comfortable understanding all the influences to reserve contributions as we make a recommendation that is just right for your association. And I hope you have some paper and are taking notes, but just to give you some peace of mind, I want to let you know that the session today is being recorded and will be uploaded to our website for future reference. We will create and send an outline to all attendees who fill out a survey at the end of today's session. And that outline will contain answers to all of the questions you ask, even the ones I don't have time to answer live. These webinars are for your benefit. We're currently working on 2 new webinars based on your feedback, so please keep those suggestions coming. I'm presuming you joined us today to learn how much of your hard-earned cash needs to be set aside in order to avoid the primary problems of special assessments and deferred maintenance. I want to eliminate confusion and build your confidence so you'll be able to budget properly sized contributions which are good for your association. There are different ways to calculate reserve contributions and they yield very different results. Just look at this table. It's possible to calculate 4 very different contribution recommendations for today's sample association. So let me begin to walk you through the influences and decision points to help you get comfortable that there is indeed a just right for your association. Let's start with the biggest influence. What do you think is the biggest influence? The largest influence is the components at your association found in the component list. This is the list of projects and association needs to plan to accomplish. It comes from the variety and type of common area assets the community is responsible to maintain. All the rest of the reserve study is built on the foundation of this reserve component list. Here's a sample component list that we'll be using today, probably shorter than most, but it'll do for the purposes of today's webinar. I expect you've all seen something like this before. Each component has a description, a useful life estimate, remaining useful life estimate, and a current cost estimate. We've done a webinar on assembling the reserve component list, so for those of you interested in learning how these components are selected, you can catch that webinar, which we call Reserve Studies 101. You can find it on YouTube or on our website, reservestudy.com. It's on the basis of that component list that we calculate reserve fund strength and the funding plan. Our Reserve Studies 102 webinar, also available on YouTube and our website, is an overview of all those calculations and the entire financial analysis side of the reserve study. And this brings us to today, Reserve Studies 103. You can probably see where I'm going. Funding calculations are going to be influenced both by the component list and the association's starting reserve fund strength. Fortunately, the curriculum and concepts I share with you today are based on National Reserve Study standards. Those standards form the basis of reserve study preparation across the country by all credentialed reserve specialists. Getting back to reserve contributions, the size of those contributions is affected by your starting point, which is reserve fund strength, typically reported in terms of percent funded. So let me show you why your starting reserve fund strength is important. To no surprise, we find that associations with relatively little in reserves, with a low percent funded, regularly have special assessments and deferred maintenance. Those associations are shown in the 0 to 30% funded range in red on the left side of this chart. Those are 2 bad things your association should avoid. The benefit to having a strong reserve fund, the green 70% and over range on the right, is the confidence that you can get your projects done in a timely manner. When the roof starts leaking or when you get feedback from an owner that their real estate agent said their unit would sell for a higher price if there was a fresh coat of paint, is no time to begin the process of trying to pass a special assessment and generate some cash. You're already suffering the consequences. Building a strong reserve fund takes years of appropriately sized contributions. If your percent funded is low, typically your association will need to have higher contributions while it's in the catch-up mode, building its reserve fund strength to avoid special assessments. The weaker the reserves are, either the longer it will take or the steeper the increases in reserve contributions your association will face, or both. And then you can imagine how the timing of your reserve expenses has an influence. If you have a large expense in the first few years, you may have to raise your contributions a bit steeper to build reserve fund size and strength in time to quickly prepare for that expense or pass a special assessment. Like you saw on that chart, reserve cash flow problems are common among associations when percent funded is in the 0 to 30% funded range. So it's good to raise your contributions enough to get out of that high risk range. This means that with exactly the same components, an association down in that 0 to 30% funded range will at least temporarily need larger contributions than the identical association that is well funded. If your association is flirting with special assessment trouble, you're going to need higher contributions. I want to take a moment while we're on this point and reinforce the fact that percent funded calculations and funding plan calculations are fundamentally different for different purposes. They both use the same component list, but that's about their only similarity. Today we're going to focus on funding plan calculations. Let's get back to our original question about how much your particular association this year needs to contribute to reserves. You now know that it's fundamentally driven by the component list and influenced by the reserve fund strength of the association, meaning if it's in catch-up mode or not. So how big are they going to be? First, we go to National Reserve Study Standards to see the guiding 4 funding principles. They state that a funding plan should provide sufficient cash when needed, keep the contributions stable through the years, evenly distribute the contributions over the homeowners over the years, so everyone pays their fair share along the way and is being fiscally responsible, compliant with governing documents and state law. Here's a reminder of the challenge. This is a typical set of reserve expenses through the years, large in some years, small or even zero in others, very irregular expense array. Per National Reserve Study Standards, you're encouraged to provide for these expenses in a smooth, fair, responsible way using the association's stable income stream. This means it's best to solve the problem of the big expense years with years of gradual preparation. I need to point out that the effects of interest and inflation over the number of years we're talking about are real and significant. They don't cancel each other out. Interest only works on the cash in the bank, while inflation has its effect on the entire value of every component, which is a much larger figure. This means that ignoring interest and inflation typically results in underestimating reserve contributions by about 10%. It'll be a losing game of catch-up as component costs inflate much faster than the interest builds up on the cash sitting in the reserve fund. Associations ignoring this very real and imbalanced effect of interest and inflation will always underestimate their reserve contributions. Now let's talk about the influence of reserve funding objectives. Earlier I introduced the concept of being behind and an association needing to increase their contributions to do some catching up and build their reserve fund strength. Let me take that concept a bit further. It's one thing to see a special assessment come in and boost your reserve contributions in order to avoid it, but there's also some value in gaining peace of mind that comes from knowing your reserves can handle all the planned expenses and some margin to handle a surprise or two. So let's look at this reserve planning chart. Let's say we're at year 0 on the left, and as we move right towards the future, special assessments and deferred maintenance will be common any year that you're down in the red 0 to 30% weak range, while those same reserve cash flow problems will be rare while you're in the green strong range above 70%. It boils down to a risk management decision, how much margin you want to build into your reserve funding plan to avoid special assessments. On the screen, you see the 3 funding goals found in National Reserve Study Standards: full, threshold, and baseline. Full means your association is pursuing the goal to be 100% fully funded. Baseline means a goal just to stay technically cash positive, and threshold is an arbitrary choice somewhere in between. What we find is that on average, full funding contributions are only 10 to 15% higher than baseline contributions. but that doesn't mean that it costs more to be fully funded. Remember, the component lists and the expenses associated with it have not changed. All we're doing is minimizing the risk of special assessments. If you put a little more into reserves, you drop the chance your owners will get hit with the great equalizer, a special assessment. If the roof fails at year 18 instead of 20, there's some value in being prepared. So your choice is really how you pay for your reserve projects. Ongoing contributions or contributions and a special assessment here and there, not how much. But because the expenses are what they are, this chart shows where these funding goals will take you. Baseline contributions by design keep less cash in the bank, but they expose the owners to a higher risk of those pesky catch-up special assessments. Associations pursuing a full funding goal will stabilize in the right side of the chart, where special assessments are rare. Associations pursuing a threshold goal will be somewhere in between. So reserve contribution size is influenced by your association's risk tolerance, and that's defined by your funding goal. Do you want to tempt fate and risk a special assessment, or do you want to set contributions $1 or $2 higher and design a plan where everyone pays their fair share over time? I recommend a strong reserve fund with low risk of special assessments. I just can't see how it's financially responsible to subject your owners to the risk of unsettling special assessments when you could increase contributions a few dollars so that every owner pays their fair share over the years. Now let's get down to some real numbers. Going back to the component list, if you take each component's cost and divide it by its useful life, you find out its fractional deterioration each year. Going halfway down the chart, you see asphalt seal coating, for example, $5,000 every 5 years. The math is easy. $5,000 divided by 5 years means reserve contributions need to offset the deterioration of $1,000 a year. For this component list, doing the same calculations for all components tells you the components are deteriorating at the rate of $20,170 per year. If all you're doing is offsetting deterioration, you won't be building your reserve fund strength or allowing it to decline. In other words, if your association is 50% funded now, that's about where you'll stay through the years. For this chart and the next 2 charts, the asterisk means I'll be ignoring interest and inflation just for the sake of simplicity. But if your reserve contributions are above the rate of deterioration, you'll be building reserve fund strength. This is how the funding objective affects reserve contributions. Building reserve fund strength from a position of low % funded will require slightly higher reserve contributions. The opposite is also true. Let's say you have some turnover on the board and a new majority says your reserves will stay cash positive if you contribute less. You can contribute less than your ongoing rate of deterioration for a while, but that will weaken your reserve fund and increase your association's risk of a special assessment. That's when owners will pay in a lump sum all that they have saved in lower contributions. So what we find is that for every association with a stable component list and good estimates for interest and inflation, there's a narrow band of contributions that will be just right. A responsible and stable plan that provides sufficient funds. We like to call this the Goldilocks chart, looking for something that fits the association just right. Now I'll turn to another influence, the calculation method. There are 2 ways to compute the contributions, straight line or cash flow. This computation method choice is significant because that even with the same component list, starting balance, and same interest and inflation assumptions, contribution size differences of 50% are common. I hope you're asking, how can that be when the contributions fund exactly the same expenses? The quick answer is that the difference is just temporary. Follow along with me. First, let's start with the component method. That's the straight line method's official National Reserve Study standard title, so that's how I'll refer to it throughout the rest of this webinar. In the component method, following its name, funding calculations are performed on individual components line item by line item. Basically, you look at the size of the upcoming cost, subtract how much you currently have on hand, and collect the amount necessary in the years available, then move down the list and do it again for the next component, and so on. In addition, its focus is on the immediate year, not any downstream effects, so no cash flow sensitivity. And it only points the association towards fully funded which it does rapidly. By now, you know that fully funded and building reserve strength rapidly are clues that make you think this is going to result in higher contributions, and you're right. This is the component list we've been using for this webinar. By focusing on individual line items, the component method will require the pool furniture fund to have $4,600 in the initial year to pay the bill for the pool furniture. The asphalt seal and the asphalt resurface funds need to each have $5,000 and $25,000 within 2 years, and the building repaint fund will need to have $50,000 by next year. Getting enough cash into each of these individual funds while funding all the others will require some high reserve contributions in the short term. If you actually do the calculations year after year, presuming the association follows the plan, this is what the multi-year funding plan looks like. High in the first few years, while the association is in steep catch-up mode, rapidly strengthening its reserve fund as it prepares for those near-term components. After those initial expenses, contributions drop down to a stable rate of deterioration level. So high contributions for a while in the first few years, dropping down to lower contributions later, are characteristic of component method contributions. The component method only pursues the conservative full funding objective. Because every component stands on its own, the component method can't share funds between components, preventing it from pursuing threshold or baseline goals. The beauty of the component method is that its calculations are very simple, finding how much more reserves you'll need for each component in time to fully fund every component for its upcoming expense. But because the average association is underfunded, component method calculations for those underfunded associations yield high contributions in the first few years. And that makes component method funding plans a tough pill to swallow for most associations. So let's shift gears now to the cash flow method. Remember, nothing has changed with respect to the components. All the same expenses exist. This way of calculating reserve contributions focuses on annual expense totals, not individual components. So for a 30-year plan, there are 30 expenses to deal with, no matter if you have 5 or 55 components. The analyst designs a multi-year income stream that offsets those expenses. It's all just income and expenses, cash flow through the entire reserve fund. Its strong suit is its flexibility. So in looking at expenses over the years, the cash flow method doesn't care if a year's expenditure is for one project or a combination of projects. It's just how much reserves are necessary to pay the expense in any given year. It's kind of like planning a flight plan for an airplane over a mountain range, preparing to fly over the peaks along the way. And because of its flexibility, you can design a nice, smooth funding plan that floats upward with inflation, so current and future owners effectively pay the same inflation-indexed contributions, all while providing sufficient funds. This is a much friendlier multi-year funding profile because it avoids the temporary high contributions characteristic of a component method funding plan. Now contrast that to the component method funding profile I showed a moment ago, where contributions start high and drop later rather than floating up gradually and smoothly. Here's a cash flow chart showing the average of contributions in yellow. Here is the component method chart showing the average of contributions in yellow. Due to funding exactly the same components, the amount going into reserves over the years is very similar. Other things being equal, only the profile is different. Here's another way to look at the difference between the two, an accounting issue. Remember, in the component method, the reserve fund is divided into separate accounts for each component and may look something like this. Unfortunately, the case too often happens that the association needs, for argument's sake, funds for asphalt and fencing, and for some reason the funds allocated to those components are insufficient to handle the expense. So the association is forced into reassigning the cash from one account to another. It's kind of like keeping all the reserves in different buckets, reassigning the cash or water from one bucket to another as necessary. In the cash flow method, reserve funds don't have a component identity. It's simply reserves available for use as necessary, and it eliminates the accounting task of tracking funds in each account and continually reassigning them when necessary. It's like having one reservoir or pool of money, and this is why the cash flow method is sometimes referred to as the pooling method. Remember, both methods fund the same component expenditures. This flexibility in the cash flow method allows it to be used to achieve any of the 3 National Reserve Study Standard funding objectives: full funding, threshold funding, or the barely cash positive baseline funding objectives by adjusting the amount of cash held in the reserve fund. So the cash flow method is nice and flexible, but too often it has been used to design contributions pursuing a baseline goal that runs the reservoir close to dry, contributions that look ridiculously small when compared to component calculations. And that can cause those cash flow contributions to be viewed suspiciously, like there's some sneaky magic going on. But no magic, it's just a combination of a different contribution profile shape over the years, and sometimes a difference in how much reserves to keep in that reservoir. Remember, it all starts with the components. We're just trying to design a funding plan that provides sufficient cash in a fiscally responsible, not risky manner, spreading out the contributions evenly and fairly over the owners over the years. Fortunately, we do this all day, every day. We know the issues, like an experienced guide knows the nuances of the trail. Having an association reserves project manager on your team means you have someone familiar with the tools, methods, and influencing factors, someone who can design a funding plan that's just right for your association. Remember, the cost of deterioration based on your components is real. This cost of deterioration is just as real as any other bill the association faces, and we don't have any magic to lower your contributions below what is needed. Just like a guide will tell you what gear to bring for a trip, we can tell you that most associations need to plan on setting aside between 15 and 40% of their total budget towards reserves. Even so, reserve contributions are not too expensive. For the average condo owner, it boils down to just a few dollars a day to pay their reserve contributions, which pay for the maintenance of their home. Just about the cost of a premium cup of coffee. Our role is to guide and counsel you through your board's reserve budget decisions with a reserve study that documents your components, calculates your starting reserve fund strength, and recommends how much you need to set aside towards reserves. We want your community to thrive, having funds to allow you to perform timely repairs and replacements that maximize home values, all done in a responsible way that follows industry standards and minimizes board member liability exposure. So in summary, it's the physical makeup of your association that makes the most difference. Your components define your expenses. When they occur matters. Interest and inflation matter. The computation method matters. We use and recommend the cash flow method for the benefit of our clients. Your reserve fund starting strength matters, and your funding objective matters. And on the last point, we like to guide our clients safely to the future, so that generally means we recommend a full funding goal. On behalf of Robert and myself, I thank you for joining us today. I've covered a lot of ground. I also want to leave you with some additional resources. If you go to our website, reservestudy.com, you'll find written and video resources under our resources tab. If you'd like our help calculating your reserve contributions, by all means, click the request a proposal link and spread the word to others that by signing up for our email list at the bottom of the webpage, they'll be notified of future free and helpful webinars like this one. We present these webinars to help boards and managers save time, avoid foolish mistakes, and pursue an improved future. So at this time, I'll turn the microphone back over to Paige, who will coordinate our Q&A time. Paige?